Welcome back to Learn Earn Crypto channel. Today, we continue to discuss the basic technical analysis. Before we begin with the technical indicators, let's see some of the commonly used terms in trading. Bull or bullish is a common term used to describe a stock or coins, a pattern, or a market in general that is characterized by upward movement. Bear or bearish. This is the reverse of bull or bullish. It is characterized by downward movement. Support. A recap from previous episode. This is an area where price is expected to stop declining after a sell-off. It is an area where buyers are waiting to buy. Support can be a horizontal or diagonal line. The diagonal lines are also called trend lines. It connects specific data points, making it easier to visualize price movements and trends. Resistance is an area where it becomes difficult for price to continue moving up. This is where the sellers dominate. Like support, resistance can be a horizontal line or a diagonal line, which typically forms in the context of a downtrend. Consolidation. It is used to describe a stock or coin's price movement within a given support and resistance range for a period of time. Traders look for support and resistance levels in price charts and then use these levels to make a buy and sell decisions. Breakout. It is used to describe price movement that got out of resistance after a long consolidation. The longer the consolidation, the stronger is the breakout. This sample shows how an ideal breakout should look like. Price tends to bounce up and down until it reaches a point where demand exceeds supply and finally breaks resistance. Volume spikes confirm breakouts. It signifies that the breakout has enough participants and is therefore valid. Pullback. It is used to describe a temporary decline in price after a previous upward move. There are two kinds of pullbacks based on structure. The classic pullback is a series of candlesticks that is arranged almost successively below each other and look like a staircase going down. The entry point is on the confirmation candle on the next day. The stop loss point is below the low. The flag, on the other hand, is a tight consolidation of candles after a momentum move. The entry is on the breakout of the flag consolidation. The stop loss can be set either below the low of the breakout candle or below the low of the entire consolidation. Moving average, or also called MAs, are used to monitor trends and to identify possible support and resistance areas. It is the average closest over a specified number of periods. The most basic form is the simple moving average, and a modification called exponential moving average. Exponential moving average, also known as EMA, is like the simple moving average except that it gives a more weight to the latest data. The moving average indicator in your charting tool can be customized. You can adjust the time period to as short as 5 days or as long as 500 days. These are my moving average settings for crypto trading. The first is the 200 SMA. It is a long-term moving average being monitored by institutions and investors to determine long-term yearly trend. Another long-term moving average is the 100 period SMA. It works well for support and resistance, especially on daily and or weekly time frame. 50 period SMA is used as trend identifier or to ride trends because it is between too short and too long term. This can also be used for swing trading. 21 period EMA is my choice when it comes to short-term trading or scalping, together with 9 EMA as this is the most responsive to price fluctuation. The golden cross is the bullish crossover of the 50-day moving average to the 200-day moving average. A golden cross indicates a long-term bull market going forward. Please note that all indicators are lagging and no indicator can truly predict the future. The dead cross term is used to describe the bearish crossover of 50-day moving average to the 200-day moving average. The term can also be used to describe any short-term moving average that is crossing down a longer-term moving average, though it is more popularly used for 50-day and 200-day moving average. This technical pattern signals negative sentiment and weakness in the market. Using moving average as support and resistance. This is the Bitcoin price chart with a 21 EMA and 50 SMA. When price action tends to stay above the moving average, it signals that price is in a general uptrend. Otherwise, it indicates that it is in a downtrend. Aside from identifying trends, the other important use of moving average is they act as support and resistance. The longer term the moving average is, the more significant support or resistance it is. The first half of the chart shows how price is always being pulled back to the moving average every time it goes too high. This is why we should be cautious in buying when price is far from moving average. The other half of the chart shows the 50 SMA keeps on pulling it up. Thank you for watching. If you like this video, turn on the notifications and subscribe for more videos.